This summer season, we've been bombarded with trending news like the surging 7 technology stocks, the Fed, the recession that never was, and even Steph Curry's hole-in-one. But we can't forget about another important market event, second quarter earnings season. So given the backdrop of the first half of 2023, how will earnings results look when companies report, and what is the forecast for the rest of the year? A conversation well worth your 10 minutes right here on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm your host, Anthony Pastore. My colleague from the Chief Investment Office, Matt Tormey, is here in the studio with me, and we're going to break down second quarter earnings. And we've really just gotten started with companies reporting, Matt. But before we get into that, just overall, what are your and the Chief Investment Office's expectations for earnings season as we get started here?
Yeah, so for the second quarter earnings season, we're expecting a relatively healthy level of beats because if we look at economic data during the second quarter, it tended to surprise to the upside. So if we look at some of the labor market data we received during the quarter, the unemployment rate remains near its historically low levels. Consumer spending is still very strong. Job growth is still solid, and demand for workers is still strong too, but moderating a little bit. So in the end, we think that the consumer remains in good shape. Household balance sheets are still flushed with excess savings, and real incomes are rising as inflation pressures cool. So these two trends are continuing to support consumer spending. And given all this data that we've been receiving, economists have been revising up their second quarter GDP estimates. So taking all this into account, we are expecting the second quarter earnings season earnings per share number to decline 3 to 5% year over year, which is better than what consensus is currently expecting and should mark the trough in year over year earnings growth this cycle. Now, if we look at it across sectors, this quarter we're expecting a pretty wide dispersion in profit growth this quarter. So on the positive side for the consumer discretionary companies, we're expecting to see the strongest earnings growth because if we look at where we were at this point last year, demand for goods was pretty weak, and this ended up leading to some disappointing numbers. And on the negative side, it's going to be the energy, materials, and healthcare sectors that are going to see the weakest earnings growth. So starting first with the energy and materials sectors, these are more commodity-oriented in nature, and these companies really benefited from the surge in commodity and oil prices that we saw last year from the Russian invasion of Ukraine. And since then, these prices have reverted back down towards pre-invasion levels. And for the healthcare companies, the large companies really benefited from the COVID-19 pandemic and the incremental boost in earnings that we saw coming out of the COVID-19 pandemic is starting to roll off.
Yeah, so I know there were some difficult comparisons with some of those sectors that you mentioned, energy, consumer discretionary, and obviously when we look at the continuing conflict and the war in Ukraine, it's had a lot of impact on prices of specifically oil. People are putting gas in their cars. It's still at high levels. So thanks for setting that up for us, Matt. Let me take it another step further with you, though. So now you've set the expectations for what earnings reporting is going to look like, perhaps. But what about the market itself and equities within the S&P 500 index, for example? How do you think they're going to perform? Because we've seen a pretty strong run-up in stocks. I mean, the markets have just been performing so well. Is there still more room to grow here? What's going to happen?
Yeah, so we think that this quarter is definitely going to be a bit more challenging for investors, and we really think they're going to be focused on the main question here that we've been thinking about for this earnings season, and that's what's the bar? So we've approached this from two different perspectives. First, the earnings bar, and second, the market bar. So just hitting on the earnings bar quickly first, corporate America does a pretty good job of providing pretty conservative guidance going into the quarter, and analysts tend to revise lower their EPS estimates for the companies so that when the companies come into their earnings season and release their results, they end up beating them for the most part.
So the bar is set a little bit low as of right now.
Exactly.
Yeah.
So we do think that the earnings bar is low right now, but for the second part of that question, what is the market bar? as you mentioned, Anthony, the S&P 500 performance going into this earnings season has been pretty strong. And in fact, in the 6 weeks going into this earnings season, the performance for the S&P 500 has been its best since the first quarter of 2021. So in our view, stocks are maybe already pricing in a pretty good earnings season coming up. And what this has done to equity market valuations is they're now looking pretty stretched above 19 times on a forward price to earnings basis. So it's typically at these levels when we would see double-digit earnings growth or interest rates at rock bottom levels, both conditions which we don't think are present today.
Right.
So we think that even if we get a good earnings season here in the second quarter, this probably won't be an upside catalyst for stocks, but instead investors are probably going to look more towards the cyclical sectors that have lagged so far this year and haven't participated as much in the rally. And in this scenario, we would prefer the energy and industrial sectors.
Right, so the equity laggards, in other words, that haven't performed as well as, say, technology has performed, especially in the last couple of months over the last year or so.
Exactly.
Yeah. Look, and let's not forget also that there are other factors out there. We still have a Fed that, according to Brian Rose, our U.S. economist here in Chief Investment Office, he expects on the 26th of July that they will raise rates another 25 basis points, but perhaps stall after that. So there's still a Fed that we're contending with, and this recession that never happened, but will it happen down the road? So there may be some investor concern kind of in the background here.
Right.
So that's something that obviously I know that you and the team are looking at. But some companies have already reported earnings. We're very early in earnings season. A couple of the banks, the financial institutions have reported. How have they been so far, and have they met your expectations?
Yeah, so as typically it is during the first week of earnings season, it is the big banks that dominate the earnings prints. But if we just take a step back first and look at the results so far at a high level, the earnings beats that we've been seeing so far have been pretty decent, which is encouraging because it's typically a good indicator of how the rest of the earnings season is going to play out. And if we look at guidance for the third quarter, although it is down for the median company that's reported so far, it's still pretty consistent with resilient earnings growth.
Terrific.
Now, on the big bank earnings, there's a few key takeaways that we're seeing so far from those that have printed results. First, a lot of the earnings beats are being driven by higher than expected net interest income. So this is the revenue that the companies are generating from their lending activities minus the money that they're paying out to depositors. Second, consumer spending is still pretty resilient, and this is despite still some uncertainty about the macro outlook from the bank management teams. And this resilient consumer spending idea is being further supported by some of the consumer sector companies that have reported so far. And third, capital strength remains in a good place at the big banks, despite the increased regulatory scrutiny that the banks have had to go through since the regional bank crisis back in March. Now, how have the stocks reacted to these beats from the big banks? Initially, they saw some pretty strong gains coming out of the gate, but given the setup coming into the earnings season, which was pretty challenging given that stocks had performed well over the past few weeks, we did see a reversal from these initial gains. So over the coming days and weeks, we're going to also hear more from the regional bank earnings, and hopefully we can get some more clarity on the impact from the crisis that we experienced earlier this year.
This year in March, exactly. We all remember those stories. So as we're wrapping up here, Matt, we've only got about a minute left, but given, there is sort of a rosy picture, but as you said, there are challenges, and especially when it comes to stock prices and valuations, you're looking at really strong performance. Maybe a lot of these stocks have already priced in a positive earnings season that's coming up, so we're going to have to pay attention to that as we go through. But how are you recommending investors position themselves now? You mentioned the laggards, the equity laggards there, but what are you recommending here to investors?
Yeah, so in the near term, we think that the upside for the U.S. equity market's probably pretty limited, and this is being driven by 5 key views. So first, as we talked about a little bit earlier, Anthony, valuations are looking pretty stretched at current levels, and as I mentioned, at these levels, we would typically see double-digit earnings growth on a forward-looking basis or interest rates at rock bottom levels, so both conditions which aren't present today. Second, sentiment isn't so depressed anymore, suggesting that the scope for money to come off the sidelines and push markets higher is probably limited from here. Third, economic surprise indices are pretty elevated because we've seen a lot of upside surprises to the economic data over the past few weeks, suggesting that the bar is now higher for these more positive surprises. And if we see any disappointing economic data over the coming weeks, then this may cause the soft landing narrative to lose some steam for investors. Fourth, we're seeing some equity market disconnect from where business sentiment currently is. So the S&P 500 year-over-year performance looks to be ahead of where the current ISM manufacturing index level is. And fifth, even on the Fed's own forecast, they're expecting economic growth to slow further and for the unemployment rate to have to pick up in order to get inflation back down to its 2% target. So we don't think this is priced into the market right now.
Matt, thank you very much. Good to have you here. And we've got a long way to go now for earnings season for 2Q. So we'll have to get you back when it's all over to take a look behind us and see how we did.
Definitely. Great. Thanks for having me, Anthony.
Yeah, you too, Matt. Good to see you. And for more information on anything we spoke about today, visit our insights page at ubs.com/views. Plus, you can follow us on social media, particularly our new Instagram channel at UBS Trending, for studios content that you're not going to find anywhere else. And as always, if you have any questions about what we spoke about today, make sure to reach out to a financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everybody, and remember to keep your eyes on what's trending. See you soon.